In this video, we're going to go over the 7 stocks you're going to want to take a look at this week. We have companies who have some strong future outlook entering into the holiday season. With Black Friday coming up and Christmas shopping beginning to start, we have some companies who are going to post some strong numbers throughout November and December, and we have some companies who share their latest earnings report over this trading week, which may lead to some volatility with regard to share price, making a solid buying opportunity. So we have 7 companies on this list that you should take a look at over the next trading week. We have companies with some strong future growth outlooks. We have some nice dividend growth companies in here as well. And we have some variety across various sectors of the market. So if you're new here, everyone, I am the Gen Z Investor. And every single Sunday, we go over companies that you should take a look at for the following trading week. We go over companies who have some new product launches, some major events coming out over the next few days, or companies who are going to share their latest earnings, which may lead to some volatility or some movement in the share price. We do this every single Sunday, so please hit that like button and subscribe for those daily videos about the market. I post every single day and discuss any major market news headline, and we go over different stocks you can buy and sell within your own personal financial freedom portfolios. So please hit the like button and subscribe, and we're going to jump right into the first stock on this week's list, which is Best Buy. Ticker BBY currently trades at over $119 a share. They are up over 60% on the 1-year chart, but as of late, they've seen a slight decline over the past month, down 1.5%. They have a market cap of over $30 billion, trade at a forward PE of 16.34, and have a current dividend yield at 1.85%. This is a retailer that I think is going to have a strong closeout to 2020. I think technology, which of course is one of the main parts of their retail business, is going to see some strong future numbers to close out this holiday season, only because consumer spending reports show that consumers at home did not have upgraded technology. The technology that they used at home was not up to date because they weren't spending as much time at home, they didn't feel the need to upgrade. But now that the new stay-at-home economy is in place, people are spending more time within their homes, that they want to upgrade their technology to something that's more efficient. So these consumer spending reports predict high technology sales to close out 2020, and Best Buy, I believe, is going to benefit from those numbers. And if we take a look, they're also reporting their earnings this week on November 24th. The revenue estimate comes in just shy of $11 billion, and we're expecting earnings per share of $1.72. And over the past 90 days, analysts have only got more bullish on this company. We've seen 22 upward revisions of earnings per share estimates and no downward revisions. So over the past 90 days, analysts have only been bumping up their expectations for Best Buy's earnings report. And if we take a look at the past 4 quarters, each and every time they beat expectations by a significant amount. In this quarter coming up that we're going to get the report this week, we're expecting over 52% year-over-year growth in earnings per share numbers. So a lot of high expectation from this report, which may send shares up even higher. And if we take a look, they currently yield 1.85%. They only pay out 30% of their earnings. So a lot of money retained back into the business in order to grow operations. And they've been growing that smaller starting yield at only 1.8% by a massive rate, average dividend growth rate over the past 5 years of over 23%. And if we take a look at their dividend safety score, it comes in as safe with an 80, so we're not worried about a dividend cut coming anytime soon. The second stock to take a look at in this week's video is Medtronic. Ticker MDT currently trades at over $110 per share, and they are down around 1.5% on the 12-month chart. So this company manufactures and sells different healthcare related products across the nation. So they are a very large company, market cap at over $148 billion, trade at a forward PE of 27, and have a yield at 2.11%. So why we have to take a look at them this week is because they're sharing their latest earnings report. So they report on November 24th with a revenue estimate of just over $7.08 billion and an earnings per share estimate of around 80 cents per share. And over the past 90 days, we've had some mixed signals from analysts, 12 up revisions, 10 downward revisions over the past 90 days, so some mixed signals regarding what analysts are expecting. And over the future years, they're expected to grow by 44% next year and a rate of 9.4% per year over the next 5 years. And the average price target for this company sits at around $119 per share right now. So a lot of upside, around 8 to 10% upside from the current share price, with a buy rating on MDT at this current moment. The current dividend yield on MDT is at 2.11%. They pay out a very sustainable 57% of their earnings as a dividend, and that nice lower starting yield at 2% has been growing at a massive rate, averaging over 12% dividend growth per year over the past 5 years, with an extremely long 42-year dividend growth streak. So this company has proven to grow their dividend during good and bad times through recessions and depressions. And their dividend safety score comes in at 99, the safest and highest dividend safety score possible. So very, very unlikely we get a dividend cut coming anytime soon for Medtronic. Target is the third company we're going to take a look at this week, and this is a company that I think is going to have a very strong fourth quarter of 2020. With Black Friday shopping coming up, I think they're going to have a huge demand. I think people are going to want to get out of their house and shop. I don't think stores are going to be jam-packed, but I think even digital shopping is going to see record highs. I think Target has the infrastructure to reach that demand. They are up over 36% this year, one of the best performing retailers that I think has a lot of room to continue to grow. They have a market cap at around $86 billion, trade at a forward PE of 19, and have a current dividend yield at 1.58%, and they are one of the best dividend growth companies on the market. They have strong future growth, expected to grow this year at over 40%. Next quarter is expected to be a record high of around 200% growth because of the expectation for Black Friday and the strong holiday season. And over the next 5 years, we're expecting over 13% annual growth from Target. And if we take a look, the current dividend yield on this company has 1.58% starting, with a payout ratio of only 30%, very, very sustainable, a lot of room to grow that dividend each and every year, and they are a dividend king with a 52-year dividend growth streak and a 5-year dividend growth rate average of over 6.4%, so overall a very nice dividend scorecard from Target. And with the holiday season coming up, I think a lot of retailers and all the ones that are going to remain open, like the Targets and like the Walmarts, are going to do very well. And if we take a look, they have a 90 dividend safety score, which is considered very safe, so a company we aren't too worried about a dividend cut coming over the short term. Moving on to number 4 on the list this week, we have Google, up over 33% this year with a market cap of $1.18 trillion and a forward PE of 34. I think this is one of the best growth stocks in the world. I think this is a company you can hold in your portfolio for decades, and I don't think they're going anywhere anytime soon. They have some of the best financials in the world. Their income statement and their balance sheet are almost unmatched out there on the market. And this is a company that blew away earnings expectations over their last result, and I think this quarter they're going to do the exact same thing. I think the fourth quarter is going to be very strong. I believe consumers are going to be faced with a ton of ads from businesses, which is only going to benefit Google's bottom line. And I think this company, their own products are going to do well closing out this year during the holiday season. And I think the ad spend on their platforms is going to be at record highs because all those companies who have survived this storm are really going to try to bolster up their sales to close out this year to kind of, fix up their 2020 numbers. And I think they're going to really go hard this calendar year and to close out 2020 over the fourth quarter. And Google is going to benefit extremely well. So we all know they have a very strong history. They're expected to grow at over 16% per year over the next 5 years. And this next quarter, we're expecting 38% growth. And if we take a look at their income statement, total revenue has been expanding at a massive rate each and every year, consistent beats on top line revenue. And if we take a look, 171 billion of total revenue in the past 12 months is absolutely incredible, with net income numbers coming in at over 35 billion. So tons and tons of net income coming into this business. They do not pay out a dividend, so a lot of money retaining back into operations in order to help grow the top and bottom line in future years. And they have one of the best balance sheets in the world once again, with around 132 billion of cash. They can do almost anything with $132 billion worth of cash. They have so much money available to them for acquisitions, to grow operations, for research and development. I think this will help them stay on top for a long period of time. Total current assets of 164 billion. Meanwhile, the entire liabilities on their balance sheet right now comes in at 86 billion. So they can pay off every single dollar of debt on the balance sheet and still have over 50 billion sitting in cash. Beautiful financial statements from Google. Like I mentioned before, almost unmatched. And this is a company you can buy at almost any time. But I think over this week, it's good to take a look at them because I think they're going to have a very strong closeout to 2020. The next two companies on the list today are both e-commerce brands that have seen some massive growth and are expected to hit record numbers over the next few years. It's sad to say that any good came from a pandemic, but for the e-commerce platforms, they've seen a massive benefit. Etsy is the first one we're going to go over today, currently trades at around $140 per share, up over 244% on the 12-month chart. But over the past month, shares have seen a decline down over 3%. This current company has a market cap of around $17.6 billion with a forward PE of 55. So Etsy's a brand I think is going to have a very strong holiday season. Black Friday and Christmas and holiday shopping is going to be really beneficial for this company because a lot of small businesses that are Etsy's main competition, so the small businesses who sell more unique goods have been shut down. The pandemic has locked up their doors and they are not operational. So the people who are searching for more unique goods for the holiday season, their only way and their only marketplace for those goods now is Etsy. And I think the platform is going to grow at an insane rate this year and continuing on into 2021. And if we take a look, the next quarter we're expecting over 300% growth. Next year we're seeing 175%. And over the next 5 years, we're expecting a 55% per year growth rate from Etsy. With a buy rating right now and a current price target set at over $160 compared to the current price at $140, a lot of upside potential for this company moving forward. And if we take a look, their income statement has been doing very well. Each and every year they've beaten new revenue highs, pushing around $1.4 billion of total revenue in the past 12 months, with beautiful net income numbers as well. Usually a lot of young tech companies continue to lose money, but Etsy is finally profitable over the past 3 to 4 years, bringing in some positive net income with around $232 million over the past 12 months. The second e-commerce brand this week is, of course, the retail killer, the e-commerce giant, and that is Amazon. Currently trades at around $3,100 per share. They are actually down 3.6% over the past month, but up over 77% over the past year. Amazon, I don't see going anywhere anytime soon. They are the largest e-commerce platform in the world. They make up more than 40% of the entire e-commerce platform across North America, and I think this is a brand that's going to grow at an insane rate moving forward. I think the pandemic has only accelerated them and put them 5 years ahead of their timeline, and I don't think there's any competitor on the market right now with the infrastructure they are building to compete with Amazon at scale. I think this company is going to be around for decades. They're diversifying themselves away from just their normal e-commerce marketplace, and I think they're doing a very nice job. Next quarter, we're expecting 83% growth. Current year, we're expecting over 51% growth and averaged 36% annual growth over the next 5 years. And a massive upside potential with current share price, currently trading around $3,100, with the average analyst expectation for the company at around $3,800. So over 15% potential upside if they can reach this share price estimate with a buy rating on the company right now. Taking a look at their financial statements, beautiful revenue growth. They've 3.5 times their revenue over the past 5 years with around $347 billion in total revenue. And each and every year, significant increases to that top line, and they're growing it at a massive rate. And their net income numbers have been growing as well. Over $17.3 billion of net income over the past 12 months. So we all know Amazon, we all know the business they operate in, and I see that industry growing at record highs, and I think the company will continue to be one of the best performing stocks on the market over the next few years. Stock number 7 on the list this week, the final company we're going to discuss is ticker HRL, Hormel Foods. The dividend king, currently trading at around $50 per share, is up 17% this year. They have a market cap of $27 billion and a forward PE at 30. Current dividend yield at 1.86%. They pay out a very sustainable 55% of their earnings as a dividend, with a huge 5-year dividend growth rate average of over 16%. It's extremely incredible to see a dividend king with a 54-year dividend growth streak continue to grow the business for that long, maintaining a sustainable payout ratio, growing that dividend at an absolutely astounding rate each and every year, and continuing to maintain the highest dividend safety score possible at 99. Just extremely, extremely impressive. To run a business and be successful for 50 years is already incredible. To grow that dividend each and every year is already astounding. And to do that with the safest dividend safety score, a sustainable payout ratio, and growing it at a massive rate of over 16%. That is huge numbers to see, and HRL is a consumer brand you may want to take a look at this week because they report their earnings on November 24th. So those were 7 companies we took a look at this week. Each and every one of them has some reasons why they're featured on this list, and they should be taken a look at or added to your watch list over the next few trading days to see how they perform. We had some earnings reports, and we have some companies who are expected to perform very nicely throughout the holiday season. So please hit that like button and subscribe. I post every single day. See you in tomorrow's video.